just 24 hours, Silicon Valley Bank, the darling of tech startups and venture capital, lost $42 billion, not a medieval run on a bank, not a rumor whispered in a city square. This was a digital bank run, faster than anything the global financial system had ever experienced. Founders, treasurers, and CEOs refreshed their apps, saw their balances vanish, and realized, in a single day, the bank they trusted was gone. But here's the terrifying part. This wasn't just about one regional bank. It was a signal. A warning echoing through history, from Rome's silver denarius collapse to the fall of Lehman Brothers. How could a bank that seemed untouchable, a pillar of innovation, crumble so quickly? And more importantly, could this happen again to your money? The answer lies in interest rate shocks, hidden bond losses, and the brutal speed of modern finance. It's a story of trust broken, of liquidity evaporating, and of an entire system's fragility revealed in real time. By the time regulators intervened, the panic had spread, not just through bank accounts, but through social media threads, investor forums, and venture capital networks. Each message amplified fear, each withdrawal fueled the next. The stage was set, a bank, a balance sheet, and billions in motion. And as the dominoes began to fall, the world watched, wondering, who would be next? The collapse of Silicon Valley Bank didn't happen overnight. It was decades in the making, hidden inside spreadsheets, bond portfolios, and assumptions about risk that never accounted for the speed of a digital age. Banks are built on trust. Depositors expect their money to be there tomorrow, even if it's lent out today. SVB, like many modern banks, relied on a delicate balance. Long-term investments funded by short-term deposits. It's a model that works only while confidence remains unshaken. So, what went wrong? The problem began with ultra-low interest rates. For years, the Federal Reserve kept borrowing costs near zero, pushing banks to search for yield. SVB invested heavily in long-duration government and mortgage bonds, seemingly safe but secretly fragile. When interest rates rose aggressively to fight inflation, the market value of those bonds fell. Not because the bonds defaulted, they didn't, but because higher rates make old bonds worth less. Imagine holding millions in assets that are technically safe but impossible to sell without a loss. Now imagine your customers, many of them tech startups and venture-backed firms, realizing the bank might be exposed. They don't have patience, they act fast. They withdraw first. The withdrawals cascade. And in the digital era, every click, tap, and swipe accelerates the panic. Ask yourself, what happens when $42 billion disappears in hours? How can a bank survive when almost 90% of deposits are uninsured above the $250,000 FDIC threshold? This is not theoretical. This is exactly what happened. Social media amplified the fear. Slack channels and Twitter feeds became arteries of panic, connecting thousands of startups in real time. Every warning post, every rumor, every hashtag, it was fuel for the fire. In minutes, fear became action, and action became a self-fulfilling collapse. The key lesson here is simple but terrifying. Banks can fail faster than regulators can react. And once confidence shatters, no amount of liquidity or capital can restore it immediately. By mid-morning, SVB was bleeding cash. The bank had to sell bonds at losses just to fund withdrawals. Each sale crystallized previously invisible losses, shrinking capital and feeding headlines. Panic spread to other banks. Investors watched, startups scrambled. The domino effect had begun. But why did this happen to one of the most celebrated banks in Silicon Valley? SVB wasn't reckless in the traditional sense. Its management followed industry norms. Its balance sheet seemed strong on paper. The danger came from concentrated deposits and mismatched duration. Vulnerabilities invisible to anyone outside the bank's vault. Here's the striking truth. Modern finance is fast, interconnected, and unforgiving. A regional bank like SVB can trigger global anxiety because our financial system is digital, networked, and confidence-dependent. When deposits flee in hours, liquidity vanishes, and regulators are forced into emergency measures, sometimes before they can even fully assess the situation. The Federal Reserve and FDIC stepped in, guaranteeing insured deposits and creating emergency funding mechanisms. Yet these measures, while stabilizing, were triage, not cure. They stopped the immediate bleeding but did nothing to address the structural weaknesses: high leverage, concentrated deposit bases, and sensitivity to interest rate shocks. Let's pause here. Ask yourself, if one mid-sized bank can create panic in the digital era, what happens if multiple banks with similar vulnerabilities face a sudden shock? Could this be a warning for systemic fragility in the U.S. banking sector? The answer, unfortunately, is yes. SVB's collapse exposed how easily fear and misinformation, amplified by social networks, can overwhelm even a well-capitalized institution. It is a modern reminder of classic banking truths. Trust is currency, and confidence is collateral. By the afternoon, the numbers became impossible to ignore. SVB had invested billions in long-term bonds, safe government and mortgage-backed securities. But safe on paper doesn't mean safe in practice. Here's the problem. When interest rates rise, the market value of older bonds drops. SVB held low-yield bonds bought during ultra-low rates. Their book value suggested stability, but selling those bonds in a hurry meant crystallizing massive losses. Ask yourself, how can a bank with seemingly billions in assets be suddenly underwater? The answer lies in duration risk, a financial term most people never think about until it destroys their savings. Each bond sale meant less capital to cover withdrawals. Each withdrawal meant more forced sales. A vicious loop had begun, invisible until the panic arrived. Even sophisticated investors initially trusted SVB. They knew the bank's history, its tech-savvy reputation, and its apparent prudence. But what no one accounted for was the speed of modern finance and the fragility of concentrated deposits. This isn't just a story about numbers. It's about trust, speed, and human behavior. Fear spreads faster than capital. Panic can wipe out billions in hours. Unlike past crises, SVB's collapse unfolded in real time on social media. Every tweet, Slack message, and news post acted like a spark on dry kindling. Imagine this: a CEO logs in to transfer funds. They see a headline, SVB under pressure. Another founder posts, can anyone confirm SVB is safe? In minutes, the panic spreads to thousands. Withdrawals accelerate. Fear becomes self-fulfilling. Ask yourself, if a single rumor can cause a run today, what does that say about the resilience of the financial system in a digital age? Traditional safeguards, deposit insurance, regulatory oversight work too slowly when information travels faster than liquidity. And here's the kicker: SVB was not alone. Many banks share similar vulnerabilities: concentrated clients, long-term bonds, and reliance on short-term deposits. The question isn't if another bank could fail, it's when. The FDIC and Federal Reserve acted quickly, guaranteeing insured deposits and creating emergency funding facilities. This intervention prevented immediate contagion. But it also raised a chilling question. If regulators can only react after the panic starts, what happens in a more interconnected crisis? The SVB case exposes a critical fragility. Our financial system relies on confidence, not just capital. One panic can cascade into multiple failures. The emergency measures stabilized the situation temporarily, but didn't fix the structural vulnerabilities. This is a stark warning for investors, tech companies, and everyday depositors alike. Your money is only as safe as public confidence, and digital finance moves faster than any regulator can. SVB is not the first bank to fall. History repeats itself. The panic of 1907 in the U.S., trust evaporated. A single bank failure nearly toppled the financial system. Lehman Brothers in 2008. Interconnectivity turned one collapse into a global financial crisis. And just like the Roman Empire's currency debasement or the Spanish silver inflation, SVB reminds us, financial systems are fragile when confidence is fragile. Ask yourself, what patterns are repeating today? What lessons have we truly learned? And what have we ignored? SVB's collapse wasn't confined to Silicon Valley. It sent shockwaves through global venture capital, affected startup funding, and shook tech markets worldwide. Banks in Europe and Asia watched closely. Investors questioned assumptions about regulatory protections, liquidity, and cross-border exposure. Suddenly, a regional bank became a global cautionary tale. This is the modern reality. Digital finance erases geography, and fear spreads faster than money. In the next crisis, a regional misstep can ripple through the entire financial ecosystem. SVB is a symptom, not the disease. Its collapse exposes a broader systemic risk: concentrated deposits in single sectors, over-reliance on low-interest borrowing, and blind faith in traditional banking metrics. The system is built on trust, speed, and leverage. When one piece fails, the consequences ripple outward. Ask yourself, if digital banking can move this fast, what protections exist for your wealth? What structural changes could prevent history from repeating? SVB's crisis ties into a larger story of the US dollar and global finance. High debt, rising interest rates, and concentrated exposures make the system inherently fragile. This is not alarmism, it's historical pattern recognition. Every major financial collapse follows a similar trajectory. Confidence falters, leverage magnifies losses, and panic accelerates the collapse. The digital era just makes it faster, louder, and more interconnected. Silicon Valley Bank's failure is more than a headline. It's a modern financial parable, a lesson in trust, risk, and the speed of money. History shows us, from ancient Rome to modern America, confidence is currency, and when it evaporates, even seemingly untouchable institutions can fall in hours. For viewers, the takeaway is clear. Understand where your deposits are held, recognize duration risk in investments, watch the signs of systemic fragility, and never underestimate how fast panic spreads in a connected digital world. The dominoes have fallen once, history suggests they could fall again. And when they do, the question is not if, but when.